Joining me now, first on CNBC, to kick off our Davos coverage here on Squawk on the Street, Citigroup Chair and CEO Jane Fraser. Welcome.
Oh, Sarah, it's lovely to be back with you again.
It's lovely to be back with you again in Davos, and on such a big market day as well. Down 1.5% on stocks, treasuries, as Mike was saying, selling off, the dollar selling off. Concerns about these Greenland threats. What do you make of it?
Well, there are certainly plenty of headlines today, and it's always important to cut through some of the noise. It's not unexpected that the markets would be selling off at the moment, but I think there's a couple of things. First of all, I think many of us in the corporate world do have some confidence that when the government leaders do engage, which they will, the allies will come to some form of resolution.
You expect
it?
A lot of them are going to be here in Davos. Trump is coming tomorrow. Macron is here. I just passed his massive entourage. I don't know. There's a headline that he's not going to be meeting with Trump. What are your expectations at this point?
My expectations that over the next few days there'll be plenty of dialogue, plenty of engagement, and I think that's what the business community will be looking to. Because when you step back, there is a general sense of optimism. I think the growth of the world is in a pretty good place at the moment. The US is operating from a position of strength. We've got consumer spending looking good over the holiday season. We've got the big, beautiful bill going to be delivering some important tax benefits in for the consumer in the spring. A lot of investment in AI and beyond from the corporate sector. And deregulation is making a difference. So I think when you cut through the noise, there's a lot of areas to be optimistic about 26 on, but it will be volatile.
And there have been surprises, mostly on the geopolitical front. And I do wonder how investors should proceed with that sort of volatility in terms of headlines. Venezuela, Iran, now Greenland, and potentially more tariffs.
So the market's been able to see through some of the noise and really focus on the fundamentals. And I think that's probably the last 5 years we've learned how to do that because there's been a lot thrown at companies and a lot thrown at the market. And they're looking at more of the longer term fundamentals. US is in a strong position. Asia we're seeing coming back in many different markets. We're hopeful of the stimulus working in Germany. And remember, companies are not the same as countries. And there's a lot of incredibly strong, resilient, successful companies out there on the front foot, including my own.
which we'll talk about in just a moment. But just on this sell-off, again, did the U.S., you keep saying the U.S. is in good shape and in a strong position. Yeah. The selling of treasuries, the selling of the dollar, the rise that we've seen in gold, there is this sort of underlying worry about sell U.S. It's a little reminiscent of what we saw after Liberation Day last year. Is that real? I mean, you guys are a very global bank. You see all the flows. Is there truth to that? Is that what's happening?
I think you're seeing some immediate reaction today. And there's always an immediate reaction to some of the headlines and noises. That is to be expected.
So you don't think the attitude has changed toward U.S. assets?
I don't see where else you go. Never bet against the American entrepreneur. The consumer is strong. The front foot on innovation in the U.S. is extraordinary. Every single company I've been meeting with today is talking M&A, is talking IPOs, is talking investment needs. And it's exciting. They're seeing productivity improvements starting to come through. So the geopolitical backdrop is a challenging one. But the companies know how to navigate through this.
You mentioned deregulation as a positive, and I know that you've been following that carefully in the financial sector, although we got another surprise, which is the president wants to cap interest rates on credit cards to 10%, which would not be good for your business.
Look, I think the president is right to focus on affordability because there are some of the consumers out there that it is tough at the moment. And that is why, as banks, we have products which are low cost, no frill, alternatives for them to make sure there's access to credit. We're the leading affordable housing lender in America. So I think there's some good products and capabilities there. But this would not be good for the economy.
What would it do?
Were this to happen, look back to the Carter administration when this was last tried in the States. Within 2 months, it was completely reversed. And that's because caps do the opposite of what you think they would and what they intend to do. They really restrict access to credit. And no one wants a situation where only the rich have access to credit cards.
Is that what would happen if a cap was put on? You wouldn't be able to.
You wouldn't be able to.
Credit?
You would not be able to provide credit and access to credit to the people who need it the most. And it's one of the ironies of it. I think that the larger macro effects are probably worrying as well. Spending would be severely curtailed because credit cards are a big driver of spending. It would have an impact through multiple sectors. So think of the airlines, think of retailers, think of hotels and restaurants, very dependent on card spend, and also the profitability from the partnerships that they have. So let's make sure that we extend access to credit. We don't restrict it.
Not a good idea. So are you lobbying Congress on this? I mean, do you think there's a realistic chance that there's bipartisan support?
No.
You don't?
I don't.
That's not what you're hearing?
I think there's a very keen understanding that this would have the opposite impact of what the actual intent would be. And that there are better ways to go about it, and we're very happy and continue to work on providing them.